Welcome to the Manitoba Ag Days podcast, where we hear from some of the most relevant, up-to-date, informational speakers in our industry. In episode 11, Brian Voth, president of IntelliFarm Inc., tells his story. Marketing is a four-letter word.
All right, good afternoon, everybody. My name is Brian Voth, president of IntelliFarm Inc., and on the screen you can see all of the six of us that make up IntelliFarm. Headed out to Brandon this morning. Here we go. Headed out to Brandon this morning, had the crystal ball loaded up. How many people were actually here for a market outlook? I'm curious, actually. Nobody? Oh, a few, okay. I think that was earlier in the day, actually. So got to Brandon, and we're walking through the parking lot, and the guys decided to play catch with the crystal ball, and this is what happened. So they broke the crystal ball, and now I'm going to have to put off the vacation I'd planned because I knew exactly where things were going to go. Yeah. So I had this really good market outlook planned. I knew exactly where markets were going to go, but I had to rewrite my entire presentation, and the only thing going through my mind was four-letter words. So buckle up. And now that I hopefully have your attention, who's ready to hear what kind of four-letter words might make up marketing? Nobody? And I am one of these speakers, when I ask a question, I will literally wait till someone answers before I keep going, even though I realize I'm the last one between you and the bar. So my name is Brian Voth. I am from Altona, Manitoba originally, heart of the Red River Valley, or God's country, as everybody likes to say. Although as I speak more and more places, I find out that anywhere that has farming apparently lives in God's country. So take that for what it's worth. But people always, I think, find it interesting when I say I do not come from any kind of farm background whatsoever. None of my family farms, none of my extended family farms, except for one uncle, and he's married into the family. So it's a little bit interesting maybe how I ended up working in agriculture when I don't come from that background. I actually grew up in a construction family. My dad bought his construction company when he was in his early 20s and still owns it, although my brother has bought out half of them at this point. And I worked for my dad for a number of years through high school and after high school. And when I was 19, he pulled me aside one day and he said, you know, I never bought this company expecting to have to pass it down to his kids, so my older brother, myself, or my younger siblings. And I never quite knew how to take that because I wasn't sure if he was trying to get rid of me or not, or if he legitimately just wanted me to go out and see if there was something else I liked doing. So at the age of 19, I went and worked on a farm for the first time. It was 2004. Who remembers what 2004 was like? A few people? It was a late start. It was a relatively cool summer, and on August 21st, we froze solid. And I thought, okay, I guess this is farming. That's cool. And it wasn't enough to deter me, so in 2005, I went and worked on another farm, and I was doing custom apps through Agricor back in the day, and working on the farm when we weren't spraying. Who remembers what 2005 was like? Nobody? Boy, we're going to do a little bit of history lessons here today then. 2005 looked a lot like 2016, where all it did was rain. The farm I was working for was about 15,000 acres. They had 6,000 acres they didn't get to touch until about July because there was just that much water on it. So I thought, well, I guess if this is ag, I must be coming in at the right time because it can only get better from here. But I decided if I'm going to stay in ag, I should probably actually go and learn something about this. And so I enrolled in the diploma program at the University of Manitoba. And they had come up with a new option called Ag Finance. And Ag Finance was geared to go into ag lending. So to go work for FCC or a bank or a credit union, but specifically doing farm plans. And within the first month or two of starting school, I realized the grain markets was what really caught my eye. And that basically changed my entire focus at that point. The unfortunate part is, in university, there is 2 courses about grain marketing. And I go back to the university every year, multiple times, and I harass them about the fact that they basically manufacture agronomists to come out of university, but they don't teach anything about marketing. Maybe that's why I have a job, I'm not sure. So after finishing my diploma, I went back, finished my degree in ag business, and while I was in diploma, I worked as a grain buyer at Bunge in Altona for a couple of years, buying canola. When I started degree, I started as an analyst and an advisor for a company out of Winnipeg, AgChief, and I worked there for 2.5 years. before making a switch, and I bought a franchise of Agritrend Marketing, which I ran for 6 years, and now for the last 2 years, we've been running completely independent. So that's my very quick intro, backstory, and relatively brief history in agriculture. So this year I've been getting asked to do more presentations in Manitoba. I do a lot of speaking, but for some reason it always seems to be out of province. And I'm trying not to read into why that is, that I'm not actually asked to speak anywhere close to home where they know me. I'm hoping that it's not because my reputation precedes me. So, contrary to how the front rows may look here, we are not in church, and I am not up here to preach at you. I actually find there's far more value out of this when there's interaction between myself and the audience, and my biggest fear is looking out on the crowd and seeing something like this. Aside from the fact that if I see you sleeping, you may get harassed by me. So, as we go, ask questions. You can stop me, you can challenge me. I love to argue, and I'm really good at it, so I invite anybody to bring that on. I actually only have 15 minutes of content, and so I'm relying on you to turn this into an hour-long presentation. I'd also like to say thanks to the Manitoba wheat and barley growers for the invitation to come and speak, specifically Dylan Wiebe for putting my name forward. I don't know, where is Dylan? Is he in here somewhere? There he is, over there on that side. Along with Pam for coordinating everything. Pam's sitting up front here. I have to say I'm a big proponent of both wheat and barley, but more in liquid form. So I've been at Ag Days for a number of years as an attendee, but never as a speaker. And if I'm not asked back next year, I guess I know how the next 45 minutes has gone already. So when I was talking to Pam about the content of this presentation, and I think this went back to September, she wanted a title. And I said, well, the discussion about a market outlook came up, and I actually cringed a little bit because I am not a fan of doing market outlooks. I've done a lot of them, and these are actually all titles of past market outlooks. I don't go with the typical market outlook and insert the year. I don't like those kind of titles. But the thing I found in doing market outlooks over the last 7 years is farmers tend to hear what they want to hear. And so in 7 years, there's been years where I'm bullish, and I say prices are going up, and what do you think farmers tell me they're going to do if I tell them that prices are going higher? You're going to have to yell, because I can't hear you otherwise. We're going to wait. There we go. Makes sense. If you think prices are going higher, why wouldn't you wait? But there's also been times where I'm bearish, and I say prices are going down. And what do you think farmers tell me they're going to do when I say I think prices are going down? They're going to wait. I said, well, why am I supposed to stand up here for an hour and tell you what I think the markets are going to do if you're just going to tell me you're going to wait no matter what? Realistically, we could probably save the next 50 minutes and go find a bar already. I actually think Dylan said he was buying, so, right? Yeah. So I always look at this and say, a market outlook is like a balance sheet. And as much as you might not like to talk about accounting, a balance sheet is accurate as of a specific point in time. But it always changes. And that can be anything from political events to weather events to black swan events that you don't see coming. So while I can do market outlooks, I prefer not to. But I do have a passion talking about how to have a plan, how to build a plan, how to modify that plan as need be depending on the year, but ultimately stick with it. Again, no problem talking about the markets, but realistically, whether the markets go up or the markets go down, you have to have a plan for your farm, and you have to carry it out either way. So, back to the four-letter words, because as much as I love what I do, swear words are a pretty common part of my vocabulary, along with all of our advisors. They may be yours as well, and this is going to be dependent on the year probably. In the last 4 months, we might have been swearing more than normal. We might guess that we're sailors half the time. Who here looked at this today, at the program before they decided what they were going to do? Anybody look at this program to see who the speakers were? How many of you read only the title? I got one guy that's going to raise his hand at least. The rest of you, we're going to have to do something about this energy here at this rate. So this is exactly why I've gone to creating what I think or hope are catchy titles. because, let's be honest, we're going to take 3 seconds, we're going to look at the titles, and we're going to decide right there what we're going to go and listen to. Marketing is not sexy, in case you hadn't realized. There's no new fancy product that will add a bushel or save you $1 here or there, and I'm not giving away a bunch of free stuff for you to show up here. Sorry to inform you. I will say, if you do want some IntelliFarm swag, you sign up as a client, and the swag is free after that. But what I do have is a passion for markets, for doing... Am I allowed to swear in this presentation? No? Ironic given the title, I guess. But I do have a passion for the markets, for looking at them, for trying to figure out where these markets are going, both on the short and the long term. Essentially doing the work that most of you don't want to do. And that's perfectly fine, because I would make a terrible agronomist. I found this picture and I was like, this picture is speaking to me, because I do not understand agronomy. What I do like to think is that I'm a semi-professional, expert-ish marketing enthusiast. And although this picture originally said business analyst, market analyst fits right into here too. Actually, one of my advisors, who happens to be my brother, we were talking about that. We said just a couple weeks ago, we said, do mom and dad actually know what we do? Again, with not coming from a farm background. And I think we came to the conclusion that they actually have no idea what it is we actually do. All right, so I'm going to try something here, and hopefully not everybody hates me. I want everybody to stand up. Not joking. Everybody stand up. Don't leave, just stand up. We're going to do an experiment here. If you don't enjoy grain marketing, sit down. I'm impressed. I thought more people would be sitting down. If you don't enjoy calling elevators to do price discovery, sit down. A few more. If you don't like comparing basis levels, sit down. Okay. If you don't like finding out what every elevator's grade and protein premiums or discounts are like, sit down. I think all my advisors are still standing, I hope, anyways. If you don't like analyzing futures and reading reports, sit down. Okay. So those of you still standing, IntelliFarm is looking for people like you, just saying. All those sitting, business cards are up at the front and the advisors are over there. These are the things we do. All jokes aside, how many of you think of 4-letter words when I go through that list of things for your farm? How many of you swear thinking about doing your cost of production? How many people have done your cost of production for 2018? A few people? All right. The rest of you, you've got a bit of time, but you should probably get on that. What about trying to decide if today is a good time to price, or should you be waiting till tomorrow or next week? How many of you are terrified of making the wrong decision? I like that we have a few honest people here. How many people are not going to raise your hand no matter what question I ask? Who wants free beer? Oh, there we go. Now we can get a few more people raising their hands. Guess what? Newsflash, you are not alone about wanting the free beer or not liking marketing. Grain marketing has never been easy, and it's been more challenging, I would say, in the last 10 to 12 years. The risk has gone up. Margins can fluctuate from plush to negative to marginal, sometimes all in the same year. The marketing strategies from 20 or 30 years ago don't work in today's environment. And in case you're wondering, this is actually a really good book. This is from a professor at the University of Minnesota who actually farms on his own too. He's got this book. It says, grain marketing is simple. It's just not easy. And it's a really good read if you're into reading about markets. So let's look at some 4-letter words to describe marketing over the last 10 years. So 2007, 2008, we called this 4-letter word poof. See, and here, you might be a little bit surprised about some of the words I picked here. Why did we call this time frame the poof time frame? Well, this bubble down here, that is the summer of 2006. That is the first year that I was buying canola for the crush plant in Altona. Canola prices went from just under $6 a bushel to about $7 a bushel. We actually had a whiteboard in the office that had the prices written out for the next 9 to 12 months that got updated on a daily basis. It is bizarre to sit here and think about the fact that we would have prices written in marker on any given day. Enough farmers just stopped by the office to find out where prices were like, that this actually worked. Can you imagine having a system like that today with what we see in the movement of prices? Fast forward, this bubble, that is the summer of 2007. That is the second year that I was buying grain, and canola prices, substantially higher than the previous year, ranged anywhere from $8.50, $9 down to $8, but somewhere in that $8 to $9 level. We still had the whiteboard, but prices were certainly moving more than they were the year before. And they were working higher as I finished that job and went back to university. Fast forward again, that red arrow, that is the first week of December 2007. That is when I started as a marketing advisor with AgChief out of Winnipeg. And again, you remember where I came into farming? Back here somewhere. This was the first couple of years in ag. This was the run-up in prices into March of 2008. So from December of 2007 to the first week of March 2008, canola rallied over $6 a bushel. Who remembers this time frame? A few people? There was lots of talk about $20 canola, and there was a lot of opportunities that got missed by not selling on this rally. Greed kicked in. If I wait another day, maybe I'll get another $1 a bushel or another 25 cents or insert any number. In March of 2008, canola went limit down consecutively. I believe it was 4 days in a row. And when a market goes limit down, the range that a market can actually trade on any given day expands. There were days when canola was dropping $50 to $80 a ton, and even if you wanted to price grain with an elevator, they wouldn't let you. How many people remember this week in March? A few people? What did it feel like to try and price grain and not even have the option to price what you had in the bin? Terrifying, maybe? Maybe swear-worthy? By the end of March, canola had dropped over $4 a bushel. So in basically 4 weeks, canola dropped $4 a bushel. Panic set in, fear took over, and yet we still sold canola for the best price that we've ever had in history. And yet people were mad about the fact that they missed the $15, the $16, the $14 canola and sold it for $11 or $12. So we saw a spring rally, which lasted until about the first week of July, which is fairly typical. And everyone got bullish again, because why wouldn't canola go back to $15 or $16? That's where it just was. And obviously, $12 canola is the new floor price. So there were farms that went out and, based on where these prices were at, upgraded entire equipment lines in one shot, which was slightly terrifying for me to hear. People were spending money like it was going out of style, but what were they not doing? Nobody was actually selling grain. So it was all based on the fact that, well, canola is now worth $14 or $15 again, and that's just where it's going to stay. Fast forward to the fall, prices dropped about $5.50 a bushel to under $10 again. So once again, panic set in, fear took over, and caused irrational selling. And this is where canola prices stayed for a while after that. So everybody wanted to sell at the high of the market, but the ironic part about the high of market is nobody knows where the high is until after the fact. The greed and fear that kicked in was the bane of many farms marketing in 2007 and 2008. Making decisions based on profitability took the emotion out of marketing. Those farmers that did that, they sold on the way up. They may have left some money on the table, but ultimately weren't that stressed about it. And keep in mind, all of this happened in the time frame of 10 months. It was quite an event to be part of, quite a terrifying event to be part of when prices started to come back down. And I'm speaking from myself, but also I think from a lot of farms, that there was a lot of four-letter words going through people's heads during this time frame. There was even more four-letter words that were going through people's minds when they couldn't cash flow things because now they hadn't sold grain or weren't able to sell grain. And then I think the bankers started swearing when they started owning farms. And yes, this happened. In 2009 and in 2010, a lot of these farms could not cash flow anything and ended up getting taken over by the banks. As a marketing advisor, I thought, well, now for sure everybody's going to want to hire us because they missed all this. Well, I was wrong. So let's look forward to the next few years. 2010 to 2013 was a bull market. I'm calling this the boom period. This graph shows the entire time frame that I spent with Ag Chief out of Winnipeg. It was about 2.5 years. And this is basically how we felt starting this job, or I felt starting this job in 2007. And this is about how it felt towards the end. The volatility dropped off, markets more or less went sideways, and it was relatively boring compared to the beginning of my career as a market analyst and advisor. But then something happened. Summer of 2010, there's something that happened that kickstarted another bull market or another run in commodity prices. Anybody want to take a guess as to what happened? Anyone? Nothing? We're going to do a little bit of history lesson here. I'll give you a hint. There was a drought. Anyone want to venture a guess as to where it might have been? It was not in the States. Close. Oh, who said that? Who said Russia? There we go. 2010 was a drought in Russia. And what ended up happening was they had extreme drought. It pulled back on their wheat production. And in 1 year, their wheat exports got cut basically by about 75%. And that kickstarted a run on the wheat prices from 2010 to 2011. So this presented many profitable pricing opportunities. But then what happened in 2011? What happened to sustain these prices? I'm just going to check. Pardon me? Sorry, I can't hear you. You're going to have to yell. Ethanol. Actually, interestingly enough, ethanol really kicked in a big way actually in the mid to late 2000s. That was part of the big boom through 2007 and 2008. It continued to be a factor going forward. But there was a specific event in 2011 that led to a continuation of prices being where they were. I'll give you a hint. It was another drought. Anybody want to guess where? Someone say South America? South America. So again, we had a drought in South America that led to sustained prices because it cut their soybean and corn production, and on a global scale, they cut out their exports quite a bit. So it kept prices sustained. So although this rally started based on the wheat market, it was continued through the corn and the bean market. There was a massive part of South America that was in extreme drought. But as we came to the end of 2011, prices were flat. South America was looking okay. There was really no issues. And then we got into 2012. And what happened in 2012? There was another event. Anyone want to take a guess on that one? U.S. drought. Yeah, we're seeing a theme here. This time was actually the U.S. drought. And the U.S. drought was exceptional. I'm not sure whether they had to make a new category for this, but a large portion of the Midwest was under exceptional drought. And what it did was it really impacted both corn and soybean yields and pushed prices way up through the fall and into the winter of 2012 to 2013. The problem was prices stayed, in my opinion, too high for too long because it brought land into production that hadn't previously been in production. And the problem being is that that land stayed in production going forward. So this led into an oversupply situation ahead. So this is just a 3-year chart of that time frame. Again, this is June of 2010. That was the Russian drought. That's what kicked it off. Through 2011, this was the South American drought that kept things going. And then this was the summer of 2012 with the U.S. drought that pushed prices up to some new record highs. So through all of this time frame, we were in a 3-year bull run. We kept our strategy. We have a pretty strict strategy that we're going to forward price a certain amount of grain prior to seeding, based on bin space requirements, based on cash flow requirements, but keeping in mind risk management. I'm going to be honest, we left some money on the table, as in any bull market you will. However, every time we priced, we were averaging our price up. So this led to an era of what I call lazy marketing. Because basically the attitude became, well, if I wait, the price is going to go up, so I'm just going to wait. And that's fine until prices don't go up anymore or prices crash. So again, the mentality became, why should I price? Every time I price, the prices go up after that anyways. Well, that was all about to change. Who remembers what 2013 was like? Anybody? I'm going to call this the oops period because there was an awful lot of missed opportunity in 2013. So back up a little bit here. Through the winter of 2012 to early spring of 2013, there was no real significant problems in South America, but the tight 2012 carryout was supporting prices. As we got into late winter and into seeding, there was good demand. That kept the carryout tight going forward. Through 2013 seeding in North America, there was no real problems, there was no delays, there was projections for good crops. Through the end of seeding, good growing conditions, and the weather premium basically got taken out of the market. The big problem was, and you can see this was basically a month and a half window where prices dropped down to a harvest low of about $11 on canola. The problem was, during this time frame, old crop canola, and I'm just using canola as an example here, but was trading for anywhere from $600 to $650 a ton, and new crop canola was trading for about $550. So to put that in perspective, old crop canola was about 15 bucks a bushel, new crop was 12. How many people want to price new crop canola for 12 bucks when your old crop canola is worth 15? Good, you don't have to raise your hand to that question because I wouldn't expect you to want to. How many people actually did sell new crop canola for 12 when your old crop was worth 15? Nobody remembers what they did? This is only 4.5 years ago, you know. So that was the real problem, was there was a big inverse in the market and it impacted people's decisions for the next year. So August, we bottomed out around 11 bucks a bushel. We had a bit of a bounce to 12. It was very short-lived, as in it lasted a few days. Who remembers what their yields were like in 2013? Anyone? Average, above or below? Anyone want to take a guess? You only have 3 options. Above. 2013 was above average yields across Western Canada. And it was actually Canada's biggest crop in history at that point of all crops. So we saw yields coming in well above average. We looked at the fact that, you know, we're seeing $11 to $12 canola, and we said we need to be pricing canola because we can pencil in a fairly obscene profit. Again, the problem being a lot of people were thinking about 2012 when canola was worth $15 and that, well, this year's canola should be worth $15 as well. Ironically, if you look at economics at all, a record yield and record high prices rarely go hand in hand. And yet, we could have sold, or we did sell, and a lot of opportunity got missed to sell very, very profitable prices. So that was all happened in a span of about 2 months. So then came 2013 and 2014. And I called this 4-letter word, whoa, because seemingly this came out of nowhere. It really didn't, but that's what it looked like. So after 3 years of steadily increasing prices, from 2010 to 2013, it was a fantastic time to be in agriculture. It was an even better time to be a market analyst because we couldn't screw up, actually. Every time we made a recommendation, it was better than the last one. That's easy. Selling in a down market is where it gets tough. So 2013 and 2014 was a shocker for a lot of people after that 3 years run of high prices. This is a graph of global production and global demand on grains over the last 20 years. And you can see production is the blue line, demand is the red line, and so there's years where production exceeds demand, there's years where production is below demand. But look at what happened here. In 2012, production was below demand, and this was 2013. So in 1 year, we shot up global production by about
8%, and effectively we rebuilt global stocks in 1 year. Who remembers what the winter of 2013 and 2014 was like? Nobody? Maybe it's a repressed memory for some. If you remember, and this is based on Winnipeg, the average temperature in December was 8 degrees below normal. Average temperature in January, below normal. February, March. It was actually on record the worst winter since 1898. Normally in Winnipeg, they average 12 days of winter with below minus 30 temperatures or a minus 30 high. That winter, there was 30 days. Who remembers how much grain got moved in the winter of 2013 and 2014? Not a whole lot. Who remembers seeing trains stranded all over the place? Few people. So the real problem was we had a record crop followed by one of the worst winters in history. So we had a lot of grain to move, and we couldn't move it. And there was above average snowfall. Normally, Winnipeg sees about 100 centimeters of snow. That year we had 155. It all just added up to a bad problem. But this too will pass. There was a big problem, big carryout. There was horrendous basis levels. Anybody remember back what canola basis levels or wheat basis levels were like back then? I believe actually the worst canola basis I saw was minus $135 a ton. To put that in perspective, that is an elevator telling you they do not want to buy your canola. Okay, so if you're going to take anything out of this presentation, write that down. So in the last couple of years, 2015 to 2017, I've titled this period the yawn period. And that's because we have been essentially in a sideways market. And market analysts have an awesome sense of humor, and we've joked about the fact that paint drying and grass growing combined has been more exciting than the markets in the last 4 months. So we've been in a sideways market due to adequate or oversupplied situation both in North America and globally. However, there are still regional needs that need to be accounted for. So since January of 15, if you look, again, we traded sideways in a range, but we had a spike up. Anybody want to take a guess as to what time of year that was? Basically, the answer's on the screen. So, is this summer? Look at that time frame. Same thing. Look at that time frame. If you haven't realized it or you haven't watched, grain prices tend to rally into summer. Whether that's based on a production problem, a weather threat, whether it's real or not, or the perceived threat of a weather problem, markets tend to rally. So even though overall we've been going sideways for 3 years now, there have been opportunities for very profitable pricing in the last couple of years. This is especially true when you factor in the yields that we've had. These have made for some really good pricing opportunities, some very good profitable opportunities. The biggest thing in sideways markets, you need to ride out the lows, capture the market rallies. We spend more of our time telling farmers not to price than we do to price grain. That's just a fact. We are only going to sell each crop probably 5, maybe 6 times out of a year, and we spend a lot of time telling guys not to call an elevator and price grain just because they feel like they should be pricing grain. So ride out the lows, price when you get into resistance levels, and negotiate basis levels. But ultimately, do something when you're at a profitable level, because you cannot go wrong, you cannot screw up your plan if you're pricing at a profit. With the above average yields that we've had in 2016 and 2017, and this is generally speaking, I'm not going to talk too far specific situations. Again, don't set your price expectations through the roof when you're making or seeing record yields on your farm. You have to have reasonable price expectations. Again, economics would dictate record yields do not go hand in hand with high prices. How many people ever did supply and demand graphs in university? Again, maybe that's not a memory you want to actually think about. I drew so many of those things I could do them in my sleep. And every single one of them shows when production is high, prices go down. However, focus on profitability. Don't get hung up on certain numbers just because you like that price. Some crops are going to have a solid return on investment, some will not. The other part about sideways markets is if the market is not giving you the opportunity for profit, it might be time to look at your costs. And again, I'm not up here to preach. I'm on a market side, but one thing that we have seen is that through 2010 to 2013, when prices were going up, costs went up with it. So in spite of higher prices, which you'd think would lead to better profitability, profitability didn't necessarily go up. That's fine when prices are high and production is good and you can pencil out that profit, but the long-term average in farming is that there is no profit. And again, you look back to that supply and demand graph, that would basically equate to profitability on farms, because in the long run, the break-even on farms goes to, or the price goes to the break-even. So, 2018, I couldn't have a presentation called Marketing's a Four-Letter Word without actually throwing in one actual four-letter word. When we started doing budgets with clients back in November, this was a fairly common word looking at profitability because there wasn't much. The budgets are tight, plain and simple. Again, the last number of years, we've been in an oversupply situation, really since 2013. And the problem is that grain prices will drop faster than what your costs will. There's always that lag for input costs or machinery costs or land costs relative to what prices are doing. So this leads to reduced or negative margins, and that needs to be managed. Again, I'm going to go to this global production and demand picture. When you look at, this is an interesting year now for 2017 because global production is slipping below global demand again, and these are 3 years worth of projected demand levels. We're probably due for a period of lower production, and that's just based on averages alone. So there are going to be opportunities when production drops below consumption. A big part of what we do is looking at what funds do. How many people hear about these index funds or these spec funds when it comes to grain markets? How many of you understand what they actually do? 2 people? These spec funds or these index funds are hedge managers. They're investors looking to make money. And basically back in the late 2000s, they realized that they couldn't get a decent return on a lot of other stocks or bonds or commodities, and they got involved in the ag markets in a pretty big way. But what they do is they buy and sell grain on paper. I'm fairly confident a lot of these people have no idea what a corn seed, a soybean seed, or a wheat seed even looks like, but they don't care. All they look at is a picture of a chart, and they look for indicators that say, I should be buying this or I should be selling this. And here's where, just as of last week, so to put this in perspective, 267,000 contracts of corn is what the funds actually have sold on paper at this point. When you go over one column, the historical net long is 372,000 contracts. As of now, they're short 267. That is an awfully big switch in a position. And one contract, again, to put this in perspective, is 5,000 bushels. So 267,000 bushels is 1-point-something billion bushels, is what these funds have sold on paper. And they can buy or sell these at any given point in time. But what this does do leads to some pretty volatile pricing. So although we may look at this and be negative about the funds being in the markets because they will push markets beyond a normal range. So if a market is supposed to trade between this range based on the fundamentals, what the funds have done is essentially extended that range, both to the upside and the downside. So we don't like these guys when they're pushing prices down below what they really should be, but nobody seems to complain when they were really realistically the ones that pushed prices up to $15, $16 a bushel for for canola and soybeans. They pushed wheat prices up to $9 or $10 on last year and in other years. So although it's a bit of a double-edged sword, they're your friends when markets are going up, but they're your enemy when markets are going down. But they're a factor that you have to pay attention to. Again, we've been in a period of low prices. However, when was the last time the funds were this short? If you look actually on that last column, we just made a new historical net short on corn. We're approaching the historical net short on soybeans. This short on soybeans was actually in 2017. The corn short, I can't actually remember what, and I can't see this laptop. What does it say? 2016. And the historical longs were in 2012 and 2013. So those are the extreme measurements. And again, this is all tracked on a daily basis because it's all reported to CFTC. So you can go and follow these things. They're posted online. It's a little tougher to find the numbers for canola. They do actually trade in canola, but it's on a way smaller scale than what they do on the U.S. commodities. But those are the extreme positions and the rough dates that they had those in. So again, period of low prices. But there is a saying in both economics and agriculture that high prices cure high prices and low prices cure low prices. Why is that? Well, when prices are high, what happens? Everybody wants to get in on this. But when prices are low, what does it do? It encourages people to get out. It's the market telling you to stop growing corn or stop growing canola because there's too much of it. So everything we do is about risk management. And the key is really pricing at a profit and managing costs. As a farmer, it pains me to say this, but you are always at 100% risk. We often get told, well, I'm not going to forward price grain because it's too risky. My argument is, if you forward price grain, what are you doing? What kind of risk are you taking on? Pardon me? Less. Well, that's one way of looking at it. But there you go. If you forward price grain, you're taking on production risk because you actually owe someone these bushels. But what you have done is actually reduced your price risk because now you've actually priced some bushels. If you don't price any bushels, I argue you don't have zero risk. You still have 100% risk. But what is that risk? Goes back, price risk. There you go. Do you want to come up to the front here and do this with me?
No, you're way better looking than me.
Okay, I'll take that as a compliment. I can't actually see you because the lights are too bright. So if you don't price a single bushel, you don't have zero risk. You still have 100% risk. But it's price risk, not production risk. And again, the marketing strategies from years ago may not cut it. Sometimes you have to think outside the box, find some new strategies, find some new tools. How many people here have a hedging account for your farm with a broker? How many of you actually use that account? Oh, less people. How many of you have been burnt on a hedge, as in burnt, I'm going to say you lost money and decided this was a terrible idea and I'm never going to do this again? You're smiling, so I'm going to assume you've been in that boat. I'm a huge fan of farms having a hedging account. What it does is it gives you opportunity to manage risk in a different way, and it helps manage price risk. So if you don't have a hedging account, I encourage you to look into it. This is not a sales pitch for me because I don't do this, but look into opening a hedging account because it does open up different opportunities for marketing aside from just selling grain to an elevator. This is quite a fascinating graph from a guy out of Purdue University. And he says markets tend to follow or work in a 29-year cycle. So you have a period of about 10 years where you have this equilibrium. You have a few years of a launch, a few years of a high or a spike, and then you come back down and you set a new base equilibrium. Who wants to take a guess as to where we might be on this graph right now? Pardon me? The new base? Where on the new base? Have you seen this chart before? Okay. His theory is that this is roughly where we are right now on the new equilibrium. It's about halfway through. So his take is that prices could stay sideways for another 4 or 5 years, 3 to 4 years, but somewhere in that time frame. Again, sideways markets tend to be a little boring, but they do still come with opportunities. The only problem is you have to take those opportunities when they are there. And to do this, you need to know your numbers, to know whether that opportunity is right for you or not. I'll give an example of this. We had a corn bid come out this summer, And it was a higher bid than what we actually saw or thought we were going to see this entire year. So we sent it out to all of our clients. We said, we need to be selling corn, getting up to X percent sold. And because we weren't sure how long this deal was going to last, we said, don't wait to talk to us, just get it done, and we'll sort out all the details after the fact. Anyone want to take a guess? It was a deal. It was either $4.50, $4.75, or $5 corn, depending on time of year. Anybody want to take a guess as to how long this deal lasted? 2 hours. That's optimistic. Lasted an hour and 29 minutes. And we have never seen corn prices go back. The average corn price now is probably about $4.10 a bushel. So those that said, well, I'm going to think about it, or I'm not sure, or I'm camping and I'm not looking at my phone, or whatever it was, missed an awful lot of opportunity. And even for us, this was July 12th. We were awfully dry, and we would have gone more aggressively sold if guys would have done it. But given how dry it was, given the time of year, we didn't want to take on that much risk. But that was a case of needing to know your numbers and being able to make a decision on the fly. The other thing that we see is always, I'll call it black swan events, but there's always events that seem to pop up out of nowhere that affect the markets. And this could be something environmental, like a weather problem somewhere around the world. This could be something political. One of my advisors actually wanted me to put a Donald Trump wall joke into this presentation somewhere. I couldn't figure out where to put that joke, though. So there's political issues. Most recently, from a political standpoint, take India and putting their tariff on importing pulses. Something that more or less came, out of the blue, came as a surprise to everybody, but had drastic impacts on the markets. So there's always going to be events in a sideways market that will turn the market one way or the other, but presents opportunities or presents risks that you need to be aware of and ride out. So end of the day, we always tell guys, know your numbers, know your cost of production, and keep it up to date. Again, since there was only about 5 people that said they've done their cost of production yet, I think the rest of you should probably be working on this. But the other thing is, how do people actually look at your cost of production after the first time you do it? Nobody? Cost of production should not be a one-and-done situation that you do in November or you do in December. You need to be looking at this and updating it as the year goes by. So after you know certain costs, update that. After you know your yields, update that. After you've made sales, update your prices. You should have this as a live tool to know where you stand and where your break-evens are at any given point in time, because how else can you make a good decision when it comes to selling grain if you don't actually know what you need to make money? Second thing, how many of you actually set a target ROI or know what you want to make on the farm? 2 people. Are you just raising your hand because I looked over there now? You feel guilty about this? Aside from what we hear from farmers a lot of time, I don't believe anybody actually works for free. So you need to know what you actually want to make on the farm. Our target ROI for everybody is 20%. And this is a return after all expenses, including depreciation, including paying your salary. Yes, we factor salary in for everybody. This is 20% equity returning back to the farm. And we know up front, we're not going to be able to do this on every crop. We're not going to be able to do this every year. And some years, that ROI is going to be negative. That is a fact of farming. But we need to know what that number is. We need to have a target to aim for. And there's certain years where that ROI is going to be 30, 40, or 50%. And you need to be smart about this because there's going to be years where that number is minus 20%. And that becomes a management issue. Price at profitable levels. When you get to a point where your yield and price that you can get pencils out at a profit, what are you going to do? What? We're going to wait, yeah. Thank you for illustrating my point. Ironically, you're sitting beside one of my clients, so I'm not sure how to take this right now, but when you get to a point where you can pencil out a profit, do something. And whether that something is selling 5% or 10 bushels an acre or all of the crop, the biggest thing is you actually need to take action and do something. Because sitting and waiting has costed a lot of farms a lot of money. Realize that markets are cyclical. Again, think about that graph. And on 29 years, They do cycle. What happens one year is not necessarily indicative of what's going to happen the next year. And this is more of a cautionary tale, thinking when prices are high and coming down, that we don't have to have our expectations set back up here.
Thanks for tuning in to the Manitoba Ag Days podcast. We'll see you next year from January 22nd to 24th, 2019.